You know, the stock market can feel like a total roller coaster, right? One minute it's soaring, the next it's plunging. But what if there was a simple way to make sense of all that chaos? Well, today we're going to dig into a really powerful idea that helps separate all that short-term noise from long-term actual value.
So this fantastic quote comes from the one and only Warren Buffett, building on an idea from his mentor, Benjamin Graham. And it just perfectly nails the market's split personality. See, on one hand, it acts like a frantic popularity contest, but on the other, it's a cold, hard measurement of what a company is truly worth.
And that really leads to the most important question you have to ask yourself. Are you just betting on what's popular right now, or are you investing in real, long-term substance? Stick with me, because by the end of this, we're going to build a framework to help you answer that.
Okay, let's break down these two personalities a bit more. You've got one side that's totally driven by headlines, by hype, by gut feelings. It's super fast, it's emotional, and honestly, it's completely unpredictable. And then you have the other side, slow, methodical, and based on cold, hard facts. Understanding how both of these work is absolutely key to surviving and even thriving as an investor. Here's a fantastic way to think about it. The voting machine is all about the sizzle, the hype, the exciting story that gets all the attention. But the weighing machine, that's all about the sausage, the actual substance of the business, its profits, its assets, its real tangible value. In the short term, that sizzle can totally drive the stock price. But over the long haul, believe me, it's the weight of the sausage that really matters. So what is it that fuels this chaotic, unpredictable voting machine? Why does it swing so wildly? Well, it all comes down to the funny quirks of human psychology, those built-in biases that mess with all of us when we're trying to make big decisions under pressure. At its very core, the voting machine runs on two primal, powerful emotions: fear and greed. When the market's hot and everyone's making money, greed takes over. People start chasing stocks and buying high. But when the market turns sour, fear kicks in, and that triggers panic selling, locking in huge losses. This emotional roller coaster is really the engine of all that short-term chaos. And then you've got herding behavior. You know this one. It's that powerful fear of missing out, or FOMO. When we see everybody else rushing to buy the latest hot stock, our gut instinct is to jump in too, a lot of times without doing any of our own homework. This is exactly how bubbles get inflated, and it's also how crashes get so much worse, as the entire herd stampedes for the exit all at once.
And finally, there's overconfidence. This is that dangerous little voice in our heads that tells us, I got this, I can outsmart the market. It leads to trading way too often, chasing trends, and taking on way too much risk. So you put those three things together, fear, herding, and overconfidence, and you have the perfect storm for a volatile voting machine that's often totally disconnected from reality.
Okay, now let's just take a breath. Let's step away from all that noise and look at the other side of the coin, the weighing machine. This is where all that emotion gets tossed out the window and calm, methodical logic takes over. It's where real, long-term value is finally decided.
Because here's the thing. Over time, all that daily noise just fades away. The market eventually stops voting, and it starts weighing. It looks at the hard facts. Is the company making more money year after year? That's earnings growth. Can it pay its bills without breaking a sweat? That's financial strength. Does it have something special that competitors just can't copy? That's its competitive advantage. In the long run, these are the things that give a company its true weight, and its stock price will eventually catch up to that reality.
So the really good news here is that you don't have to be a victim of the voting machine's crazy mood swings. You can actually choose to be a weigher. And to do that, you just need the right tools in your investor's toolkit. The first and most important tool is asset allocation. You can think of it like the blueprint for your entire investment house. It's really just about deciding how to split your money between different buckets, like stocks for growth, bonds for stability, and cash for safety, all based on your own personal goals and how much risk you're comfortable with.
And this leads us right to the next tool, which is an idea you've heard a million times. Don't put all your eggs in one basket. This is the heart of diversification. I love the analogy of a street vendor who sells both umbrellas and sunglasses. By having both, they lower their risk of having a terrible day, no matter if it's rainy or sunny. Investing works the exact same way.
And true diversification, the kind that really works, goes so much deeper than just owning a few different stocks. It means spreading your money across different asset classes, like stocks and bonds. It means diversifying within those classes, owning big companies and small companies. It also means investing geographically in different countries around the world.
Every single layer adds another level of protection against taking a big hit in any one area.
So for most of us, these are the three main building blocks. Stocks are your growth engine. They're the heavy hitters that can get you huge returns, but they can also strike out. Bonds are generally more stable. They offer more modest returns with a lot less volatility. And then there's cash. It's the safest for sure, but it also gives you the lowest return. A smart asset allocation strategy is all about finding the right mix of these three for you.
Okay, so we've got our tools ready. Asset allocation, diversification. But there's one final, absolutely crucial element that really acts like a superpower. It's the thing that turns a good strategy into a truly great one. And that is patience.
Now here's a really powerful way to look at this. Don't just think of patience as a personality trait, being able to wait. Think of it as a resource that you have to actively manage, kind of like the battery on your phone. It's the energy that lets you stick to your plan when the voting machine is going absolutely nuts. And if you don't manage it, that battery can run out right when you need it the most.
And this chart right here shows you exactly why that battery is so important. Look at this. When you invest in a company you think is undervalued, your chance of being right in the first year is actually pretty low. The voting machine is still in charge. But as time goes on, look at how the odds shift dramatically in your favor. By year 5 or 6, the probability that the market finally recognizes the company's true value, its weight, grows by a huge amount. Patience literally gives your investment the time it needs to work.
And this isn't just a nice idea. It has a real, measurable impact. Some fascinating research found that having a patient, long-term approach can add what they call a long horizon premium of up to 1.5% to your returns every single year. I mean, over an entire investing lifetime, that is an absolute game changer.
So when you put it all together, the main takeaway is pretty clear. To really align yourself with the weighing machine and build lasting wealth, you've got to master the tools of asset allocation and diversification. But more than anything, you have to learn to treat your own patience as your most valuable asset. It's the one thing that allows you to tune out the noise of the voting machine and just wait for the weighing machine to do its thing. So the final question isn't just if you'll be patient, but how will you actively manage and protect that patience along your journey?